The covered call option strategy is a great strategy for existing stock market investors because the covered call strategy reduces the loss potential on the shares of stock that you're holding. It can create a stream of revenue each month should the stock price not increase too significantly. It increases the probability of making money while holding shares of stock. And lastly, the covered call strategy is very easy to execute, which we'll talk about in just a moment. In this video, I'm going to visually explain to you exactly how the covered call option strategy works. We're going to walk through historical trade examples so you can see how the strategy makes and loses money in real historical stock market scenarios. And lastly, I'm going to show you exactly how to set up a covered call using real brokerage software. So be sure to stay tuned because all that's coming up right now. Now really quickly, if you're brand new to the channel, be sure to subscribe and enable notifications so that you can get notified whenever I upload new options trading videos. The covered call option strategy is very popular among long-term stock investors because it can reduce the loss potential on the shares. It can create a stream of income on those shares so long as the stock price does not increase too significantly. And lastly, the strategy is very easy to execute and follow. Let's start by talking about the two components of the covered call option strategy. The covered call option strategy consists of two components, the first being owning at least 100 shares of any stock, and the second component is selling a call option against the shares of stock that you own. To be clear, you have to have at least 100 shares of stock for every one call option that you sell for it to be a true covered call position. Selling a call option all by itself without owning any shares of stock is an incredibly risky strategy because call options increase in value as the share price continues to increase because the ability to purchase shares of stock at the call option strike price becomes more and more valuable as the share price appreciates. Since there's no limit to how much a stock's price can increase, there's also no limit to how much a call option on that particular stock can appreciate to. So let's look at an example to show you what I mean. As an example, let's say we have a $250 stock and a trader sells the $275 call option for $5 in premium, which means they're selling the call option with a strike price of $275 and they're collecting $5 for selling that option. Now let's say that option expires in 30 days. If some news came out and the stock price increased from $250 to $350 over that time period, that $275 call option is going to be worth at least $75 because the stock price at $350 is now $75 above the call's strike price, and a call option will always be worth at least its intrinsic value, which is the difference between the stock price and the call's strike price. If a trader sells a call option for $5 and the call option appreciates to $75, that equates to a loss of $7,000 just for one call option that was sold, and if you have more contracts, that loss scales up with the number of contracts. So all by itself, selling a call option is a highly risky strategy because there's no limit to how much a stock's price can increase, and since call options increase in value as the share price also increases, there's no limit to how much a call option's value can increase to, which makes selling a call option all by itself an extremely risky strategy. Now when combined with owning 100 shares of stock, selling a call option is not risky at all because with 100 shares of stock already in your possession, if the stock price does increase significantly above the call's strike price, you as the call seller will just have the obligation to sell your shares of stock at the call's strike price, and you'll also keep the premium that you collected when selling that call option. So getting back to our previous example, if a trader owned 100 shares of the stock that was initially trading for $250 and they sold the $275 call option for $5 in premium, that means that the trader is accepting the fact that if the stock price is above $275 at expiration, they will have to sell their 100 shares of stock for $275 per share, but they will also keep the premium that they collected for selling the call option. So in our example, if the trader bought 100 shares of stock for $250 and they sold the $275 call option for $5 in premium, if the stock price increased to $350, that trader would have to sell their shares of stock at the call's strike price of $275, which would realize a gain of $25 per share, and on 100 shares, that would be a gain of $2,500. Now, since the trader also collected $5 in premium for selling the $275 call option, they would keep that as well if they hold the trade through expiration, and that means the total trade profit would be $3,000, $2,500 of which coming from the appreciation of the shares, and $500 of that profit coming from the option that they sold initially. In short, by selling a call option against 100 shares of stock, you are collecting option premium in exchange for giving up the upside at any price above that call's strike price. So in our previous example, the trader was buying 100 shares of stock for $250 a share, and they were selling the 275 call for $5 in premium. Now that essentially means that the trader is accepting $500 in premium in exchange for forfeiting any gains in the stock above $275, which is the call's strike price. So this particular trader would only do this trade if they believe that the stock that they're trading or holding would not appreciate to a price above the call's strike price at expiration, because ideally a covered call trader keeps all of the profits from the call that they sell, which would occur if the stock price remains below the strike price, and ideally they want to keep holding their shares in the future so that they can sell another call option once the current call option expires and they have that profit in their account. In our previous example, you may have noticed that if the call option was not sold, the profit on the position would have been $10,000, because if the investor buys 100 shares of stock for $250 and the share price goes up to $350, they have a $100 gain per share, and on 100 shares, the total gain is $10,000. So this brings up the big downside of trading covered calls, which is that when you sell a call option against 100 shares of stock, you are essentially accepting the option premium in exchange for any upside above the call option's strike price that you sell. So in our example where we bought 100 shares of stock for $250 a share and sold the 275 call option for $5, we're collecting $5 in exchange for giving up any upside on the shares above $275. So with that being said, investors who are extremely bullish on their stock that they're holding may not want to sell call options against their shares of stock at all, because as I just mentioned, by selling a call option, you are giving up any gains on the shares at any price above the call option strike price. And if you think the stock price is going to increase significantly in the near future, then selling a call option in exchange for all the upside above that call option's strike price doesn't make any sense. Let's move on and visualize a hypothetical covered call position and compare it to just holding 100 shares of stock, so you can clearly see the differences between just holding 100 shares of stock and selling a call option against those shares to create a covered call position. So for this example, let's assume I buy 100 shares of stock for $75 a share, which is a $7,500 investment. Then to create a covered call position, I sell the call option with a strike price of $80 for $3 in premium, and let's say this call option with a strike price of $80 is expiring in 30 days. Now keep in mind that if I'm collecting $3 for an option, that actually means I'm collecting $300 in option premium, because every standard stock option corresponds to 100 shares of stock. So when you look at a option price of $3, that option's value is actually $300. In short, I'm buying 100 shares of stock at $75 a share, which is a $7,500 investment, and I'm selling the 30-day 80 strike call option for $300 in premium. Let's take a look at the expiration payoff graph for this particular covered call position compared to the payoff graph of simply holding 100 shares of stock purchased at $75 per share. The first thing to notice about this graph is that the break-even price of the covered call position is $72, which is $3 below the share purchase price of $75 per share. That's because if I purchase 100 shares of stock for $75 per share and I sell a call option against those shares and collect $3 in premium, my effective purchase price of those shares is essentially decreased by the amount of premium I collected for selling that option. A covered call's break-even price is equal to the share purchase price less the premium received for the call option that you sell. By selling a call option against your shares of stock, you actually create some downside protection for your shares of stock, which is one reason the covered call position is so popular. The break-even price of $72 makes sense because at expiration, if the stock price is at $72, on 100 shares of stock, my loss on those shares would be $300, since I've lost $3 per share and own 100 shares. But since I sold that 80 call option for $3, if the stock price is at $72 when that option expires, that call option's value will be $0, because call options with strike prices above the stock price have no value at expiration. And if I sold that option for $3, that means my profit would be $3, and in actual profit terms, that would be $300, since every option contract corresponds to 100 shares of stock. If the stock price is at $72, I'll have a $300 loss on my share position, but I'll have a $300 gain on the option portion of the position, and that results in $0 in profits and losses, which means I break even on the trade. Now, if we compare the profit and loss levels of the 100 share position and the covered call position, we can see that the covered call position will outperform the long share position by itself at almost every single stock price, because by collecting option premium from selling that call option premium either reduces our loss potential or increases our profit potential at almost every single stock price. As I mentioned earlier, the big downside of trading covered call positions is that you give up any upside on the shares at any price above the strike price of the call that you sell. The benefit of having enhanced profitability and reduced loss potential at most stock prices comes at the cost of giving up all of your unlimited profit potential above the call's strike price. If the stock price is above the short call's strike price at expiration, the covered call trader has two choices. The first choice is to allow the option to expire in the money, and that would mean that they would effectively sell their shares of stock at the call's strike price, because if you hold a call option through expiration and that call option has value at expiration, that call option will automatically be exercised, which means anyone who owns that option will buy 100 shares of stock at the call's strike price. And on the other side of that, it means that anyone who is short that call option, such as a covered call trader, will effectively sell 100 shares of stock at the call's strike price. The second choice a covered call trader has at expiration, if the stock price is above the call's strike price, is to buy back the short call option for whatever price it's currently trading for. That's the only way to keep your shares of stock if you are a covered call trader, because as I mentioned earlier, if the stock price is above the call's strike price and you hold that position through expiration, that call option will automatically be exercised, which means you as the option seller will be assigned on that short call option, which means you will sell 100 shares of stock at the call's strike price. So if you are adamant about keeping your shares of stock and you do not want to sell them, you will have to buy back the call option at expiration for whatever price it's currently trading for, which likely means you'll be taking a loss on the call portion of that trade if you are buying back that call option at a price higher than you sold it for. But even in that scenario, you will still have a profit on the overall covered call position. Before we move on to analyzing historical covered call positions, I'm going to hop over to the Tastyworks trading platform and show you exactly how to set up a covered call position. So I've just opened up the Tastyworks trading platform and I'm currently looking at Apple options in the middle here. So we have all the option expiration cycles for Apple. Now, as of this recording, Apple is trading around $204.30. And the first component of a covered call position, as we know, is buying 100 shares of stock. Now, to do that on the Tastyworks trading platform, all I have to do is click on the ask price, and if I do that, we can see on the bottom here, it queues up an order to buy 100 shares of Apple stock at $204.28, which is the mid price between the bid and ask price. So the bid price being $204.18, the ask price being $204.38. The halfway point between that is $204.28. The first thing I want you to notice is that the maximum profit potential is theoretically unlimited, which is designated right here by this little infinity symbol. And that's because since there's no limit to how much Apple's stock price can increase to, there's theoretically no limit to the profit potential on this position. The maximum loss potential is $20,428, which stems from the fact that if I buy 100 shares of Apple at $204.28 per share, the maximum loss is $204.28 per share. And on 100 shares, the maximum loss potential would be $20,428. We can actually visualize the profit and loss potential of this position by clicking on the curve and making sure analysis is checked. The profit and loss graph is very linear because since we're buying 100 shares of stock, for every $1 increase in Apple's stock price, this position will profit by $100, and for every $1 decrease in Apple's stock price, this position will lose $100. Now, if I go back to the table view, we know that we have to sell a call option to create a covered call position. So I'm going to open up the June 2019 options, and let's say I want to sell this 210 call option for around $5 in premium. To do that, I can just go ahead and click on the bid price of $4.95, and this queues up in order to sell the 210 call option at the mid price, which is between $4.95 and $5.10. Now at the bottom here, we can see that the mid price of this overall position, so buying the shares at the mid price and selling this call option at the mid price, gives us a mid price of $199.26. And the first thing I want you to notice is that the maximum profit potential is now defined to $1,074, and the maximum loss potential has actually decreased to $19,926. And that's because if I sell this call option collecting about $500 in premium, the loss potential on buying 100 shares of stock is decreased by about $500. Now, the maximum profit potential of $1,074 comes from the fact that if I buy this position for a total cost of $199.26, the most I can make is going to be if Apple goes to $210 or more, in which case I'll have to sell my 100 shares of Apple stock at $210 per share. And if I buy this position for $199.26 and it appreciates to a valuation of $210, the profit will be $1,074 or $10.74 per share. So essentially you just have to take the call's strike price of $210 less the cost of the position at entry, which is $199.26, and the difference between these numbers is $10.74. So basically, if I buy 100 shares of Apple stock and sell this call option, my effective purchase price of the shares will be $199.26, and the highest price I can sell these shares for, since I sold the 210 call option, would be $210. So at any price above $210, my profit on this position will be $1,074. And we can visualize that once more by clicking on the curve view and analyzing this position's profitability. As we can see here, at any price above $210, the profit at expiration is $1,074, since I have to sell 100 shares of Apple stock at $210 per share if Apple is above the call's strike price of $210 at expiration. As we can see here, the break-even price is actually below the current Apple stock price of around $204.30, and that's because if I buy this position for a total cost of $199.26, that means my break-even price is $199.26, as we can see here. Now that I've just shown you how to set up a covered call using real brokerage software, let's go look at some historical covered call trade examples so you can see exactly how a covered call might perform in various scenarios. Keep in mind that in these upcoming examples, the specific stock does not matter at all because the general concepts will carry over to other covered call positions on other stocks. The important thing to understand is how these covered call positions performed and why. In this first example, we're going to look at a scenario where the covered call position does not make as much money as simply buying and holding 100 shares of stock. Here are the historical trade details for this first example. At the time of entering the trade, the stock price was at $121.45, and to set up the covered call position, we purchased 100 shares of stock for $121.45. To complete the covered call position, I sold the 125 call option for $1.41, and that option had 74 days to expiration. The maximum profit on this particular covered call position is $496, which can be calculated by taking the difference between the call strike price of $125, the share purchase price of $121.45, and adding the call premium to it, which is $1.41. The expiration break-even price of this position is the share purchase price of $121.45, less the credit we received from the call option, which is $1.41, and if I take $121.45, which is the share purchase price, and subtract the call premium of $1.41, we get a break-even price of $120.04. Let's take a look at how this trade performed. As we can see, the stock price increased substantially over the first month, rising to a price of $134 per share at approximately 35 days to expiration. With the stock price at $134, the profit on the covered call position was right around $500, which essentially means the covered call position was already trading at the maximum profit potential, since we know that the maximum profit potential of this covered call position was $496 based on our calculations earlier. The position of just holding 100 shares of stock had a profit of around $1,250, and that's because without the call option sold against those shares, the position of owning 100 shares of stock has unlimited profit potential in theory, because that position will get more and more valuable with every increase in the share price, since there's no call options sold against those shares. In this example, since the stock price increased to a value much higher than the call's strike price of $125, the covered call position underperformed in terms of profitability relative to just buying and holding 100 shares of stock. And this example highlights the downside of trading covered calls, which is if the stock price increases significantly and is above the call's strike price at expiration, that covered call position will underperform the profitability of just buying and holding 100 shares of stock. In this next example, we're going to look at a scenario where the stock price did not change much over the entire trade duration, which means that the covered call position's profitability is going to be much higher than simply holding 100 shares of stock, because when you buy and hold 100 shares of stock, if the stock price does not increase, you will not make any money. Whereas with a covered call, you still have that short call portion of the trade, and if the stock price doesn't increase, you will have profits that stem from selling that call option, while you have no profits from your share position itself. So here are the trade details. First, the stock price at entry is $116.45, which means we purchased 100 shares of stock for $116.45. To complete the covered call position, we sold the 120 call option for $5.80, and that call option had 53 days to expiration at the time of purchasing the shares of stock. This particular covered call position had a maximum profit of $935, which is calculated by taking the difference between the call strike price and the share purchase price, plus the call premium that we received at the time of entering the trade. The expiration break-even price of this covered call position is $110.65, which comes from the share purchase price of $116.45 less the call premium received of $5.80. Let's take a look at how the two strategies performed side by side. The main point to get across in this particular example is that the stock price ended very close to the price where it began, which means simply buying and holding 100 shares of stock would have virtually no profits or losses. But in this example, since we did have a covered call that collected $5.80 in premium for selling the call option, we can see that the covered call position actually had a profit of around $580 at expiration. And that's because at expiration, if the stock price is below the call's strike price, that call option will expire worthless. And if I sell a call option for $5.80 in premium, I'm actually collecting $580. And if that option price goes to zero, then my profit on that option trade will be $580. This is really the ideal scenario that you encounter when trading a covered call, as you can experience profits on holding shares of stock at no additional risk, and if the stock price just trades flat over the time that you have that call option in your portfolio, your covered call position will still profit even though the share position itself is not profiting at all, because since you've sold that call option and the stock price is not increasing, that call option's value will steadily decrease as its expiration date approaches, and that will generate profits for you as an options trader. Now that we've gone over multiple covered call examples and I've shown you how the strategy works, how does one go about selecting a specific call option to sell when trading a covered call position? Choosing which call option to sell as part of a covered call position depends on your particular outlook for that stock and over a specified time period. Now, in terms of the number of days to expiration on the option that you're selling, the most common time period would be somewhere between 30 and 60 days to expiration, since if you sell an option with 90 days or 120 days to expiration, those options are going to experience a much slower rate of decay relative to a 30 or 60 day option, because options decay more and more as they approach their expiration dates. Another benefit of selling a call option with 30 to 60 days to expiration is that you'll be able to readjust your stock price outlook and your call's strike price more often than you would if you would have sold a call option with 150 days or more to expiration. The amount of premium collected for selling that particular call option should also play a role in determining whether or not it's even worth it to trade a covered call position, as opposed to just continuing to hold 100 shares of stock. Because if you look at a call option that you want to sell and you're only collecting 50 cents and you're giving up all your upside above that call strike price, maybe that premium of 50 cents doesn't justify the fact that you're giving up the share upside, and in that case, you just hold your shares of stock and choose to not sell a call against those shares. Now, to quickly demonstrate what I mean by all of this, I'm going to hop over to the Tastyworks trading platform once more, and we're going to analyze different call options that could be sold for a particular covered call position, and we're going to weigh the pros and cons of each of those call options that we could potentially sell. So getting back to our Apple covered call example from earlier, if I purchase 100 shares of stock of Apple for $204.28, the next thing I have to do to create a covered call position is choose a call option to sell. As I just mentioned, selling a call option is a balancing act between the amount of premium that you want to collect, or the amount of downside protection that you want, and the likelihood that you're going to have to sell your shares of stock if the stock price is above the call's strike price at expiration. One thing that I could do, which would be the most aggressive covered call position, is to sell the 205 call option for around $7.25 in premium. So if I do that, we can see that my maximum loss potential is $19,703 and my maximum profit potential is $797. And that's because if I sell this 205 call option, there's really only 70 cents for Apple to increase before my profitability on the share position is capped. But I will still profit from the premium collected from the call option, which is why this maximum profit is around $800. So in this scenario, since Apple only has to increase about 70 cents before it's above my call's strike price, I will collect the most amount of premium for selling this call option, but I also have the highest likelihood of having to sell my Apple stock at expiration because there's a very high likelihood that Apple could be above $205 at expiration in 55 days. Now let's say I did not want to sell my Apple stock and I wanted to keep the shares, in which case I would have to sell a higher strike call option, such as the 215 call option. But if I sell the 215 call option, you'll notice that I'll only collect about $3.30 in premium, as opposed to around $7.25 in premium. So in this scenario, we can see that my maximum profit is $1,404, but my maximum loss potential is $20,096. So by selling a higher strike call option and collecting less premium, I will have more profit potential because there's more distance between the current stock price and the called strike price, which means I have more profit potential on the share position. But by selling this 215 call option as opposed to the 205 call option, I collect less premium overall, which means I have less downside protection should Apple stock decrease. And we can see that by looking at the maximum loss potential of $20,096 compared to the maximum loss potential of $19,703 if I were to sell the 205 call option. So in short, when choosing a call option to sell, you really have to figure out how much you want to keep your shares of stock, because if you really want to keep the shares of stock, you're probably going to want to sell a call option at a higher strike price, but you also don't want to go to too high of a strike price, because if you go to too high of a strike price, as we can see here, the premium that you collect for selling that call option gets very, very low, which means selling the call option becomes less advantageous for you as a covered call trader. The last thing that you have to keep in mind before selling a call option against your 100 shares of stock is that if the stock price is above the call's strike price at expiration, you could be in a scenario where you have to sell your shares of stock. So if you're in a position where you want to keep your shares of stock and you do not want to sell them, but you still want to implement a covered call position, then you're going to have to choose a higher strike price that has a lower probability of being in the money at expiration. Now, if you don't care so much about selling your shares of stock and you want more downside protection, then you can sell a call option with a lower strike price, in which case you'll collect more premium and have more downside protection on your shares, but that comes at the cost of having a higher likelihood of having to sell your shares, since your call option strike price is closer to the stock price and smaller stock price increases are more likely than larger stock price increases. In other words, deciding which call to sell is a balancing act between how much downside protection you want or how much premium you want to collect for selling that option and how likely you are to sell your shares of stock at the called strike price. To wrap up this video, I'm going to go through a couple frequently asked questions regarding covered calls. The first question is, can you trade a covered call position with more than 100 shares of stock? And the answer is yes. As long as you have 100 shares of stock, you can sell one call option against your shares of stock, and you don't necessarily have to cover all of your shares of stock that you own. For example, if you have 350 shares of a stock and you sell two call options against those 350 shares, only 200 of those shares will be covered calls, and the additional 150 shares that you own will be uncapped and still have the unlimited profit potential because those 150 shares do not have a call option sold against them. A second frequently asked question is, do you have to hold a covered call position through expiration, or can the covered call position be closed early prior to expiration? The answer is that any option or stock position can be closed at any time. You just have to pay whatever the current price is for that strategy. So for instance, if you wanted to close your covered call at any moment, what you would have to do is sell your 100 shares of stock and buy back the short call option at the same time, which would effectively close your covered call position. And at that moment, your profit or loss would be dependent on how much you sold your shares for and how much you paid to buy back the option. But you don't have to close the entire covered call position, because if you just wanted to close the call portion of the position, all you'd have to do is buy back the short call option at whatever price it's currently trading for in the market, in which case you would realize a profit or loss dependent on how much you paid to buy back that short call option, but you would still have your shares of stock. The next question is there any way to avoid being assigned on that short call option if it is in the money? The answer to this is no. If you sell an option and the option is in the money, you have no control over when someone exercises that option, and since you have no control over when someone exercises that option, you have no control over when you are assigned on that option. The good news is that options with lots of extrinsic value are very unlikely to be exercised, because any trader who exercises an option with lots of extrinsic value will lose 100% of the extrinsic value that was in the option when they exercise that option. The only way to truly avoid being assigned on a short option that is in the money is to buy back that option and close it altogether. But as I just mentioned, as long as the option has lots of extrinsic value remaining, that option is not likely at all to be exercised, which means you as the option seller have a very low probability of being assigned on that option. Please give this video a like if you enjoyed it, and feel free to leave a comment down below, because believe it or not, I do answer almost every single comment that is left on my videos. So if you have a question about this video, drop a comment down below and I will answer you as soon as possible. That's going to do it for this video on covered calls, everybody. I really hope you enjoyed this video and learned something from it. Once again, I'm Chris from Project Option, and I will see you in the next video.